The two biggest issues with hoteliers right now isn't getting clients into their hotels. It's the high cost of insurance, which we've seen go up dramatically in the last 2 years, and
Yes.
staffing issues, getting people to work at the hotel,
Yes.
especially in these
Right.
high income areas where it's expensive.
Larry, again, thank you for coming on. I always like to start with background. Where did
Yep.
you grow up?
Grew up in Orange County, Fountain Valley, California. Just before the OC was the OC, we called it Orange County. So yeah,
Okay.
grew up in Orange County, middle class suburb. Fountain Valley, just right near, about 5 miles off the coast in Southern California. Good little place to grow up. We used to see the fireworks every night at Disneyland. So when
Oh,
people talk about
nice.
fireworks shows, I'm tired of
Yeah,
fireworks. I've been watching them since I was a kid. You
I'm
know,
sure.
yeah. So.
Grew up there at Fountain View. Where'd you go from there? Where'd you go to college?
Yeah, then from there we left, went a little north up to the University of California, Santa Barbara, the
Okay.
Gauchos, and so I studied economics, finance there. This is like late '80s. I'm aging myself, and I really thought I'd have a career in real estate. But at that time, as I was graduating, we were at war with Iraq, and I was doing an internship in a local commercial real estate firm, and he's like, "Hey, I wouldn't start this gig right now." So uh,
Huh.
changed my direction, went to finance, worked at Merrill Lynch as a stockbroker early on. Was there about 8 years out in Seal Beach, California, right near Leisure World, again,
Okay.
Orange County. And then
Yep.
moved over to an one of the money managing firms with the Consults Group at Merrill Lynch. We was looking to hire a regional guy, so I joined that firm based in Santa Monica, California. So I've worked my way up along the coast. Now our home office is in Beverly Hills, though we don't spend as much time there as we used to. We go there more
Okay.
as a celebration or a reason to hire a new hire or a milestone, so to speak. But I've always find myself near the coast in California, which isn't a bad place to live.
No, no, it's not. I've spent a little bit of time out there, but not nearly enough.
Yep.
Um, my brother lives in San Francisco, so I get out
Yep.
there every once in a while, but even there, don't get out nearly enough. A little bit on your background. You've obviously have a very, very strong finance and economics background. How did you come to be solely focused on hotel financing? What was that journey like?
Gosh, that was about 21 years ago. I met with one of the founders of the firm, and he was on a flight to from Seattle to California, and we spent the whole 2 hours talking baseball. And we were both in suits, first class, and we didn't talk a single thing about the finance, just all about baseball. And then he
Nice.
invited me over to the offices in Beverly Hills, talked about the opportunities he's looking for. He felt I had a right background for it. At the time, I didn't know anything about hotels. It sounded very unique. This is 2004, 2003, 2004-ish, where market was okay, not great. So
Yeah.
I saw his vision, and it seemed like something to delve into. And then 2, 3 years later, we have a big crash in finance. So that was a challenging time, a good time to learn.
Yeah.
And since
Yep.
then, it's been a pretty good ride. I mean, we had a really good time chase from 2013 to COVID was probably the good old days in hotel financing or in financing in general. We didn't
Yeah.
realize we were in the good old days when we were in them. But then when
Of
COVID
course.
hit, we realized that, wow, we're not in the good old days anymore. So it's been a challenge since COVID with various, rates and things that have popped up.
Yeah.
But I've got time, as time flies. I'm like, wow, 20 years in hotel finance. So it's flown by, good times and bad times. But can't change your path, and it's been a very rewarding career. Very rewarding career.
Good. Good. That's awesome. Overall, what would you say? What's one thing that most hotel owners misunderstand about hotel loans actually work?
Yeah, they're generally as not as cognizant of what they need to get qualified. For example, unfortunately, a lot of hotel owners are looking at profitability from how much money they make internally. But if they don't report these little side incomes, it's going to affect their ability to borrow money. I have many sponsors that come to me on the smaller deals and say, look, our earnings say that we're earning this much money, but we really earn this much money. I'm like, well, that's great, but we can't report that. We can't do the loan based off how much you really earn. It's how much that you pay taxes on. And
Right.
that's surprising to some of these sponsors. A lot of them don't realize the market we're in today in 2025. You just aren't getting the same leverage you got 5, 7, 8 years ago. There was a
Right.
time I was doing conventional, getting 75% loan to value, loan to cost wasn't hard. It was kind of common. nowadays, even with a strong flag, we're getting 65, maybe 70 if everything lines up right. So they're just not getting as much purchasing power as they used to, or they've come to get used to, especially
Yeah.
those that have come from multifamily where they're used to getting much higher leverage. And they come into
Yes.
hotels. I'm like, guys, this is a little riskier to the bank. So therefore, you're not going to get as much leverage and your rate's going to be higher. So that's most of the two biggest issues with me is knowing the market today and also knowing that your income has to be reported to count. It's probably what comes up on the smaller loans.
Yeah. Yeah, absolutely. Makes a big difference. Take a step back,
Yep.
10,000-foot view. How would you describe the current lending environment for hotels in 2025?
Yeah, it's very challenging. The sad part is you go to these lodges, you go to these hotel conferences, you meet with hoteliers, you see all the energy, all the excitement, all the
Yes.
optimism. It feels great. The lodging conference was last week in Phoenix. Everyone,
Yep.
it's like you're on a high, on a cloud nine. And then you get back to the office, you call the loan committee up, and they're as gloomy can be. And so many loan committees just don't have it, they're not cognizant of what's going on in hospitality. Now they're doing other asset classes. I understand that, but they just fall in the typical, they think hotel risk. And that's just not the market today. I'd much rather own a hotel than an office building today. And that's just my opinion. There's certain
Agreed.
asset classes, the risks have changed. Um, with hospitality today, so many banks are just afraid of hotels. They have a simplicity, whether they got burned in 2007 or 8, which is possible. And, some banks took back some hotels during COVID. A once in a generational thing happened. We didn't expect it, and it did hurt some banks in taking back hotels. They actually had to increase their back offices to handle the extra babysitting of some of these bad hotel loans. But
Hmm.
if you realize it really wasn't structural, it wasn't anything to do with the product. It was again once in a lifetime virus that caused it, and most of them have bounced back since then. And so, just getting the negative, the instinctive hotels are afraid to some of these older, crustier old loan committees that just aren't more. I apologize for the term, but just aren't as open to today what's going on in hotels in 2025. That's all.
Right. Right. Absolutely. It does definitely makes a big difference. How have the rising interest rates over the last couple of years, the massive inflation that we've seen,
Yeah.
how have those particularly changed lender appetites for hospitality?
Well, it's changed the borrowers. I mean, the borrowers got some. They go to refi a debt. They're like they used to have pay 4.5%, and now we've got 9.5%. And now that's harder for these deals to pencil.
Yeah.
Um, the banks are making plenty of money right now, Chase. They're more than fine. And that's the sad part is I've talked to many banks, and they don't want to. In their eyes, they see hotels as risky, and they're doing fine without risk. So they don't want to add risk to their lifestyle. I speak to a bank that hit their numbers in April, and they just didn't want to add any more hotels. If they did add hotels, it was going to be to VIP customers. So ones that
Sure.
they've been doing, and to be a VIP customer, you need big deposits. So they're like, Larry, we'll do that loan, but it's for our VIP customers. We'll do a $10 million loan for you, but they need to drop 1.5 million in our bank as a to be a VIP customer. So it's just
Right.
some of the things have changed that weren't around 7, 8 years ago when things were a lot easier to get, hotels financed. Um,
Yep.
that's what's going on. And of course, rates are always going to fluctuate. They are trending down a little bit now. So again, in any situation where rates are trending down, it's going to make deals pencil a little bit more, a little bit better. And again, I think we'll see another couple here shortly that just fractional, but every little bit helps, every little fraction helps. So
Yeah.
they are trending back down. I don't know if we'll ever see what we saw in 2017 or 16. Maybe we will in my kid's lifetime. I'm not sure I'll see it in my
Ye-
lifetime. Again, we
Right.
lived in it and we didn't appreciate it in the moment. Again, my parents bought a house in the Reagan era, or excuse me, in the Ford era, and we've seen both sides of it in
Yes.
25 years. So great times, but I think we are heading in the right direction. But these today's rates are still historically very competitive where they've been over the last 70
Yeah.
years.
Yeah.
Yeah.
Absolutely. That's a good perspective to have. Who is lending today? Banks, SBA, CMBS, debt funds, insurance
Well,
companies. What are you
CMBS
seeing?
is always your best rate as far as clients that are very rate sensitive. And their default rate is only 16, 17% now. So they've been leveling out. They're not seeing a high influx of defaults. Conventional wise, there's conventional money out there, but you're not going to get the leverage. But the path of least resistance right now, Chase, for hospitality financing, whether you're buying or building, is going SBA 504 green. I can, with a flagged property, I can get you 80% leverage. You'll get a construction loan or you'll get a takeout at 25-year amortization. And the last deal I
Yep.
did, the rate came out to 6.99. That we just had we just had the SBA debentures priced on Monday, and they came down to
Hmm.
5.78%. And when you do a blended rate, that's the first time it's been under 7 in a long time. And to get
Nice.
80% leverage with money under 7%, that's just not bad, you know? So
Yeah.
that is my path of least resistance. And I can go up to $30 million with that. And so that's a good chunk of money.
Okay.
And again, the green product, you can do as many green hotels as you want. There's no more limit anymore. On the
Okay.
SBA 7A product, you can borrow 5 million. For many years when the green came out, you could only borrow 16.5 million, but they've gotten rid of that amount. So now you can borrow as many as you want that qualify SBA green. And so that's the
Okay.
path. That's why I said the path of least resistance, where we'll have the highest chance to get our deal funded in a reasonable amount. Reasonable.
You talked about the 7A up to 5 million,
Yep.
right? There's no limit on the 504 green. What's the timeline look like to get either of those done?
Well, a construction is going to be a little bit more than a
Yep.
acquisition. When you go green, you have one more report to do other than an SBA 504 normal. It's just to get qualified for green. So
Yep.
someone come out and see what you got to do extra. Do you need to put solar panels on your hotel? Do you need to change all the insulation in the hotel? So, and states are different. Some percent only need 10% improvement. Some require 15%. So it fluctuates a little bit, but I can get SBA 7As done probably under 60 days. And again, SBA 504, an acquisition or refi, probably 75 to 80 on a
Yep.
hotel construction. It might be a little bit more, and I say it because it's just so many back offices get busy or they're just not staffed enough. And
Right.
if a third party report like an appraisal or environmental comes in slower than usual, that's going to slow the timeline down. But we always tell clients that when they do a PSA, always ask for as much extra time as you can get. We can get you a commitment letter in easily 30 to 45 days. And as far as funding, sometimes again we've got Christmas coming up, we've got Thanksgiving coming up.
Yes.
Those slow things down. The back offices aren't 100%, and so I
Good.
can promise myself every year I won't be stressed out between Christmas and New Year's. And every year something comes up, a 1031 exchange, and I'm at Christmas dinner with a glass of wine in my hand. And I'm trying to get a deal closed before the end of the year. I try to avoid that, but certainly if the
Yes.
sponsor gets the information in a timely manner, we get these deals done in under 90 days, easily.
Okay.
Yeah.
For the SBA, if you're not going the actual green route, and I have a follow up question after that
Yeah.
as far
Yeah.
as specifics on qualifying for the green. But if you're not hitting the 504 green, is it still unlimited, or do you have a cap on how much that
You're
you can have
capped at
there?
5 million. You're capped at 5
Still at the
million.
five? Okay,
Yeah, and it's very SBA is always changing the rules. So if you've got four partners, and if any one of them has any SBA debt, that will count against you. So that
got it.
4 million, that 5 million adds up really fast. So that's
Yep.
why I tend to lean towards green. And again, green you can get 5.5 instead of 5. So if you're getting money at 5.75%, I want to squeeze as much of it as possible. And if you're building, it's so easy to get green qualification. Just because
Yeah.
the way you're building today, everything's gonna be green anyway. You just gotta get it stamped of approval. It's a little more
Yes.
awkward if you're buying a hotel in Dallas and you're not doing any kind of PIP or any kind of upgrade. Then it might be, that 504 green might be a little bit more challenging in finding that extra ability to go green. But again, it's simpler because sometimes many hoteliers just don't own one hotel; they own multiple hotels, and if they've got
Yes.
SBA debt elsewhere, it just makes it cleaner. I don't have to worry about getting a report come back and says, oh, he's already got $3.8 million of SBA debt. We only can use 1.2. Bank's not willing to do this deal because you need more than 1.2 if we're going to lend you 7. So banks
Yep.
can take back a little bit. They can do pari passu, but they're still going to want a big chunk of that money to go SBA because it's just the safer route for them.
Yep, absolutely. Say you have somebody that is looking at buying an 80s, 90s construction build in order
Yep.
to hit the green. What are some things that you've seen that they're doing in order to qualify?
Well, if it's that old, that's 30 years old. There's going to be a lot of things that are needed on that PIP, and so
Yeah.
that's going to be a big PIP. Um, I see a few of those, and I mean, we just did one in Dallas, Texas, with a $9 million acquisition. It was a $6 million PIP because
Ooh,
they had to switch over. And some of these flags are being, I don't want to drop any names, but they're just very particular. If you want 25-year franchise agreement, you're going to have to do check all these boxes.
right.
So it's harder when you've got to say a flag that's only or a building that's only 6 years old, and they want to flip it from one flag to the other, and they want to go green. It usually has to do with windowsills, and if they're open if they're open to solar, depending on their region.
Okay.
So it's case by case. But the older the hotel, the easier it is to get because they're doing a lot more repairs anyway. So when they're doing more repairs,
Yeah.
you'll do that. Yeah.
Yeah, exactly. That makes a lot of sense, especially if you're swapping brands or doing
Yep.
something. You're going to have naturally a, like you said, a larger PIP anyway. Might as well jump in and do this kind of stuff. As far as timeline, how long do you have? If you're going to be buying that property, you're going to need a $6 million. Knowing you want to qualify for this loan, how
Yep.
long do you have in order to do that work?
Well, it's a good question. You know, when we were going through COVID, a lot of the franchises were very fair. They knew we were going through COVID. They were delaying PIPs. But
Yeah.
when you're doing an acquisition of a large amount and you're doing a PIP, it's it's smarter to do the whole financing at once to get the PIP included in your long-term finance,
Yes.
especially if you're going to SBA, because it's going to be difficult to refinance that. You'll have prepayment penalties. So in most cases, and the flag, the lender will want to see that PIP because they're basing your new pro forma on that PIP included, a nice, pretty hotel with a pool. And if we don't have that pretty hotel, the chances of us hitting those numbers that we put in the pro forma are going to be more challenging. So usually everyone wants the PIP to start as soon as possible or to be completed within a year,
Yeah.
usually 6 months to a
Yeah.
year. If it's a smaller
Okay.
PIP, the hotel stays open. Sometimes they could do it by floor. You know, the four-story building, they'll do it floor by floor. But
Yep.
generally speaking, it's easier to pay for the PIP up front and have it wrapped in your overall financing package so you're not having to do a second or a refi, which can be costly.
Yep. And you're able to wrap all of it into the 504 green.
Yeah, absolutely. That's actually part of the sales pitch is that you're converting one flag
Yep.
to the next. This is why it's going to do so much better because we have this, this, and this. And the previous hotel, which underperformed, didn't have that. So it makes it as a sales pitch almost to prove that this is why if we do this, this will come, sort of.
Right. Right. That makes sense.
Yeah.
Overall, how do lenders typically view branded versus independent?
That's a great question. In the United States, sadly, the so many CLOs and loan communities are they love flags. They love it. They're so cozy and comfy with reservation systems. How am I going to fill this hotel in
Yes.
Fargo, North Dakota in December on a Wednesday? Well, our cozy little reservation system will do it. But there's if you go to Europe or outside the U.S., their loan communities are way more into boutiques. They're way more into non-flagged. Why not? Why save? You can save the franchise fee right there. And so, in the United States,
Right.
everyone is so cozy with flags. Now, I will say there's certain markets like in Florida or Nashville where or you're by the coastline. If you have natural drivers, you're near a
Yeah.
university, then you can easily pitch those boutiques as being or Palm Springs. Just doing one in Palm Springs right now. Um,
Uh,
and so you already have the natural weather. You've got the great location. You're downtown. You have these drivers that are instant and obvious. And so those are easier to get done if you have those drivers. If you don't have those drivers, the flag goes a long way, unfortunately. Even though you're paying a franchise fee, the loan committees feel again a safety in the reservation system, keeping you flowing with people in your hotel. And that's when they look at the star reports and say, you know, if they can get this flag in here, we should consistently be 75% occupancy. We're good to go. If you go boutique, we don't feel safe, and so we will not approve a non-flagged product here. And that's usually what happens.
yeah. That makes sense. And it's across a lot of different areas too. Like insurance is
Yep,
far
absolutely.
more affordable for a flagged hotel than an independent. It's crazy,
Absolutely.
but it's true.
I'm glad you brought that up right now. The two biggest issues with hoteliers right now isn't getting clients into their hotels. It's the high cost of insurance, which we've seen go up dramatically the last 2 years, and
Yes.
staffing issues, getting people to work at their hotel,
Yes.
especially in these
Right.
high income areas where it's expensive. And
Yeah.
so loan communities are all worried about the star reports and how the revenue is going to flow in, and the hotelier is like, my insurance costs have doubled and I can't find anyone to work. And so their worries are different than what the loan committee's worries are. And so it's funny to
Yeah.
try and put them together, because most markets have returned to COVID or better. The ones that haven't are just the ones that were so driven by the business traveler, ones that were near a Fortune 500 company, in Bentonville, Arkansas, right next to Walmart. That was a cash cow before the COVID hit.
Yeah.
So those are the
Yeah.
ones that have been hurt the most. And and I hate to bring up politics, but some of the cities where we've seen some increased unsettlement within the Portlands and Seattles and San Francisco's and Minneapolis, those have been hurt a little bit. It feels like the all the steam right now in my sector is in the South. I mean, I kid that I'm in the SEC territory. No,
Yep.
Nashville, Texas, the Carolinas, Georgia, Florida. That's where all the, whether it's tax breaks or weather, everyone's coming here, and that's where most of my energy is being focused today. And that can change, but generally speaking, the South is where all the action is right now.
Yeah. Yeah. Good. Good. Realistic DSCR LTV targets in today's
Yeah,
market. I know you talked a little bit about the LTV earlier, but
yeah.
what are you seeing?
Well, realistically, the less they're borrowing, the lower their payments. Therefore, it's easier to cover their bet. They're not, and so obviously, clients want to borrow as much as they can. But I'd like to see in a conventional market, if we can go debt coverage at least 1.4. If they're really struggling or if they're having some issues and they're not hitting 1.4, that's where the SBA is more generous. I mean, all you got to do is hit 1.15 in SBA and you can qualify. So we'd like to see the debt coverage, at least 1.4, and some lenders are even higher. Some are at 1.5 and above. And again, that's just
Hmm.
the loan committee is saying, look, we're open to hotels, but we want home runs. We don't want singles and doubles.
Right.
Uh,
Right.
so um, I think there's always a story to each hotel. What's going on? I had a hotel that went through a flood, a major flood, and that hurt the numbers for a year. And so their numbers were down. But if you saw what the hotel did before the flood, you'd say that's a pretty safe bet. And so it
Yeah.
varies case by case. But loan communities, they feel safer with higher, better revenue. Debt service at a higher amount than lower, and they'd like to see less leverage than the user what the sponsor wants to borrow. I've got guys that will do boutique hotels at 55 or 60%. That's the level they'll lend at. Even some of the
Wow.
bigger lenders right now on a good flag are wanting on a conventional side 60, maybe 65 if the star is unbelievable, the perform is unbelievable, the market. But that's where it's at. And it's a little bit lower than where we saw it trend at just 5, 6 years ago.
Right. Right.
Yeah.
How do recourse and non-recourse loans fit into the current landscape?
Yeah, it's so challenging. If the client wants non-recourse, I recommend CMBS. But it's hard to sell a story. I just did a hotel in the Keys last week. Beautiful hotel. The sponsor just bought it, wants to go non-recourse. No, it's a turnaround story and it's non-recourse. So it's sort of like, okay, bank, I want you to take all the risk, not me. And so if you want to go non-recourse, you're going to pay for it. And then if
Yeah.
you're going to go non-recourse and pay for it, does that really pencil? And so I know there's clients that only want to go non-recourse. It's out there. It's pricey. The path of least resist, better resist. The path to get funded easier is going recourse, paying a little bit less than your rate. Therefore, the pencil's better. But there are non-recourse options. But I usually go CMBS in those situations, just the 5 year.
Yep.
Um, and so they're out there. But again, you have to take a little risk once in a while. And if you're not willing to carry the risk, why are you going to put it on the bank's shoulders?
Right. That's true. That's true. Looking at creative capital stacks, what creative or hybrid financing structures are you seeing owners use to make deals work?
Yeah, the big one these days is CPACE. The CPACE product is a very nice product. It's got a very low rate. And I would love to add CPACE into my capital stack on every deal. Unfortunately, a piece of it goes in front of the first mortgage, and there's some lenders that will put nothing in front of the first mortgage to do a first mortgage. So not every county has said yes to CPACE, and
Hmm.
many banks are still don't understand the fundamentals or simply aren't willing to put the CPACE product in front. So I would say that's the most prevalent I'm seeing now in capital stacks, and I think it's improving. I think more and more banks are being more open minded. It's just if you're going to go C-PACE, you're going to probably want to have 2 times as much real equity than in C-PACE dollars. I get capital stacks sometimes where someone puts in $10 million of C-PACE and they put in $2.5 million of their own money, and I'm like, no, that's not going to work, guys. I know the C-PACE
Right.
guys want to sell that, but the bank's going to say no way in hell. We'll do a little bit of C-PACE, but we're not going to do 2 times more than your true equity. So that's the most
Yes.
common thing we're seeing now is the C-PACE. Again, it's case by case, and I think it's making strides. I think 5 years from today, Chase, we'll be seeing more of it, but we're not quite there yet in my circles.
Okay.
Yeah,
And in the effort of no hotel you're left behind, describe
yeah.
what CPACE is.
It's a pseudo piece of equity. It's I'm not the CPACE rep, but it can be sold as a piece of equity. But if you do it's a piece of the capital stack that is, but in the eyes of CPACE is equity, and in the eyes of first mortgage lenders, it's debt. There is tied to some environmental issues, but it's just a very affordable stack. I think the last one I saw was at 7%, so it's probably 5% cheaper than mez debt. So
Okay.
it's way more affordable than Mez, but it's got some intricacies that are a little different. But because of that, it's a little more difficult. But I don't want to stand. Sometimes, whenever I talk C-Pace, I get my C-Pace guy on to answer all the questions because even I'm still getting somewhat familiar with some of the nuances of it and what the strengths are of it and how to address the downside of it. So
Yeah,
I
it's a different
apologize.
structure.
It is. And again, if you look at it from the CPACE guys, you love it. If you look at it from the first lenders guys, you don't like it. It's just a matter of finding the positives in both. I mean, it really only goes in front of tax issues. I mean, if that client didn't pay their taxes, then the CPACE gets paid before the first mortgage. But it's
Okay.
still anything in front of the first is going to spook a conventional lender, and they're just
Yeah.
instinctively going to say no, no, no. So that's just the nature of the beast. But yeah, hopefully,
Yep.
we'll see it differently in 5 years.
Yeah. We're coming up on Halloween.
Yep.
Give me a Halloween horror story, an example of a deal that was difficult to finance, but you ultimately got it done.
Gosh, I would say it's when you buy a hotel and you take on a big change or transition. We did a deal, it was just a small SBA, or it should have been a small SBA deal in Texas. We bought the hotel, we had to do a $1 million PIP. Turns out we needed an extra $1 million for the elevator. The elevator was all screwed up. And
Ooh.
so the elevators aren't cheap. And so the client was already highly leveraged at 80% prior to this elevator issue. And
Okay.
so the bank is like, we're like, okay, you can either add another $1 million per pursuit of this loan, or you're going to take back a hotel with a defaultive elevator and it's only 80% complete. So thankfully, cooler heads prevailed. We guys are screaming. I'm on conference calls, lenders screaming at him to sue. There's conferences, everyone wants to sue each other. I'm like, guys, the bank will do it. You got to put in $100,000 more. So long story short, the cooler heads prevailed. They were able to put a little bit more money in. The bank took on more leverage than they wanted to take on. Hotel got complete, and last I saw, it was doing pretty well. They were paying all their bills. So it was a situation where we bought a hotel. We thought it was almost done and ready to go, but the elevator was completely dysfunctional and it had to be completely replaced. And elevators are very expensive.
Yeah. And they're a little bit useful, right? People like to have elevators in a
You
hotel.
exactly. You have to have elevators. Again, it's one of those deals when you're buying an old hotel and you think that everything works good, and you hire a GC that says everything works good, and then clearly the GC didn't do their homework when they took on that hotel, and
Yeah.
so it's like we've already pot committed, so it's just getting the bank to lend a little bit more. Otherwise, they're going to take back a hotel without a working elevator and it's 80% complete. So
Right.
that's what comes back out of it. But it worked out. Again, knock on wood. I haven't heard any news that them being not paying their debt, so it's been moving forward well.
Yeah. Yeah.
I don't. No, I don't like those Hollywood stories. I have a hard enough time as it is. If I've got a deal sometimes where you get a construction loan and the lender's just not giving out disbursements fast enough to the GC to build the hotel, it could be that's a 12-month nightmare. You get phone calls, oh well, we need our money, and it's like, guys, give them their money so they can build the hotel. And the bank says we need to see the receipts, we need to see what's going on, and so.
Right.
Um, I don't like those kind of nightmares. Those are what kids say that makes dad grumpy. Stay out of dad's office. He's a little grumpy today. It's the Halloween
Yes.
time stories that do it.
It's always a better Halloween story if it happens to somebody else.
Absolutely, absolutely.
How can owners best position themselves to attract competitive financing options?
Well, they've always got to stay very keep their books clean, keep them. It's sometimes the your first impression is huge. So if you have a very easy to read easy to read numbers as far as your income comes in, it's very well reported, it's very well documented. So being
Hmm.
very clean and presentable, so having nice spreadsheets, being very clean and presentable is one very underrated fashion of the industry. When you look disheveled, disorganized, it gives a very bad impression, especially with hotels. They're seeing so
Yeah.
many the with so many banks not doing hotel loans, the ones that are seeing loans are getting a ton of them. So to stay on the front stack, you want to make a good impression, and it's having clean records, clean information, a nice everything looks nice and easy and tidy, and everything's dated nicely. Nothing worse than submitting a construction deal and you look on it like this is dated 2023. This has been shopped or hasn't been done for 2 years. That's giving a
Yeah.
very bad impression. So just small things like being clean, having everything up to date, makes a huge impression with banks.
Right. What should an owner have ready before starting the financing process?
Well, if it's an acquisition, simply a pro forma, it's always a good idea to have a good list of all the drivers to your market, meaning what's driving business to the hotel. And I tell
Yeah.
clients all the time, I want you to print out a local calendar of everything going on in that town every weekend of the year and
Hmm.
let them see what's going on in that marketplace. So having good drivers, if you have commercial clients, let's say you're a hotel near the airport and you've got 4 airlines or 5 airlines that send you clients, have a list of those airlines and the contact for those because that's huge. You have again
Oh,
another
yeah.
big Fortune 500 company in town, and you have their corporate account. List that all the corporates that you have that account for is huge. There's a
Right.
couple markets right now that are growing that haven't. Kokomo, Indiana. They just built a huge battery factory there. It's got 20,000 employees that need a job, that need a place to stay. So there's been a huge influx of apartments and hotels in that market. So having a good understanding of the market and what the drivers are, why we need to add another 200 room hotel to a market, is also important. And also having, a good understanding again of all the companies in your market and what relationships you have with them and what can drive potential. I mean, a loan committee feels so much better if they know that there's going to be 75% of the rooms are filled up because of those 6 companies in town that are going to fill it up. We don't have to
Right.
rely on the festival or rely on tourism or something. It's a safety in those corporate accounts.
Yeah.
Very
Yep.
helpful.
Absolutely. Absolutely. And I've talked to so many hotel owners, especially like the bigger companies, and a lot of them say that their year is set, and they set their budgets off those
Yep.
pre-sales, the company, the corporate stuff, and then like the tourism, everything else just kind of helps fill the rooms from there. But if you can start off with a good solid base, even if it's 20% of your hotel, but you're filling that up, that's a solid base to get
Yeah.
everything moving.
That's another example in Kokomo. We had a construction loan that we did, and literally the sponsor had this hotel filled up for 14 months after it was built from the corporations right there. How do you turn that down? How do you possibly?
Right.
And they're going to build a factory. It's not going to go away. It's not like someone's going to
Yeah.
go away. It's not Taylor Swift's going to show up for the weekend and leave. That
Right.
company's going to be there forever. And so when
Yes.
that happens, how do you say no to that? It's
Yeah.
it's 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 such a no brainer.
Yep. Absolutely. What are some of the common mistakes that owners make when approaching lenders or brokers?
Gosh, well, they're not. They don't have a. So if you want debt, we'd like to know who the equity team is. Okay, if you're dying to have equity, we'd like to know how this debt's going to be figured. And lenders always want to see the equity team. The sooner the equity team is formed, then we can see their bios. We can see their PFSs. So having a clear understanding of what the equity pie is, because again, if their PFSs are going to play a big role in how much money we can borrow. So coming in with a clear understanding of your equity team is so much easier to get debt. When you come in with, well, we'll get this guy or we'll add this guy, those are pieces that are unknown, and the more unknowns you have trying to get debt makes it more challenging. Because again,
Yes.
if I have all the answers to the questions, then they can't ask me anything they don't have an answer for. And so, and if they are if they're good answers, why would you turn that down if we've only got part of the equity figured out, so we don't know who the other sponsor is going to be, it could change it. It changes the whole perspective of the group. So having a good, already formed equity team makes it much easier to get debt.
Yep. Yep. That makes a lot of sense. The what there's a quote. It's kind of passing me now, but um, well, it's more so on the buy side that a confused buyer won't buy. I think that's the same on the lending side. If they're confused or there's
Yeah,
unknowns, it just makes everything more risky.
absolutely. When you can go to the loan committee, you sit there and they ask these questions. You have an answer for everything. They've got their answers. When you go in there and you give them, I
Yeah.
don't know, then that they have then that gives them the reason to say we don't want. We're going to pass on this for now. Let's revisit it when they've got this figured out more. And so having that
Yes.
concise equity team makes it so much easier to just to proceed. And
Yep.
I will say another thing that can be challenging is in some cases if you have two hotel groups, it's easier if two hotel groups that go in as partners go in and that same pie goes out to acquire a second or third hotel simply for collateral purposes. Because if you
Okay.
have a fourth owner who's not part of the first hotel but part of the second hotel, you might want to need that hotel as collateral. So it's easier if your partnership stays together. Because you jump
Right.
around, you can then use that piece of that asset as collateral, even though you don't want to sell it. It's just simply the ability to borrow more money makes it easier when you're that same group versus one person is not part of this new group, so it screws everything up.
Yep. Yep.
Like,
No, that
why
makes
would
a
they
lot
want
of
to
sense.
expose themselves to a risk if they're not part of this new venture? And so, just staying within the same equity partners makes things a little easier if you're acquiring multiple hotels, which many sponsors do. They go from building one hotel to the next. They
Yes.
don't put their money in a pile. They don't bury their money under the mattress. Most hoteliers take every nickel they got and go on to the next deal, the next
Yep.
deal. That's why they're
Yep.
not very. Many of them aren't very liquid because they make more money using their money to build hotels and buy them than have it sit in the bank making 4%. So that's
Right.
what comes up too.
Yeah. Yeah. Exactly. And it makes sense that do what you know and do all of it. Warren Buffett's quote that like don't put your eggs in a bunch of basket, put it in one basket in hotels and watch that basket.
Yeah, it's you saw it especially during COVID. And once COVID hit, a lot of lenders were just afraid of lending to anybody who didn't have hotel experience. And
Yeah.
I have doctors that have their families have got generations of hotel experience, but they didn't have experience. And they're like, sorry, I'm sure he's a great doctor. I'm sure he can treat me well here, but we don't feel comfortable with him. He doesn't have any hotel experience. And so,
Right.
yeah, it
Yep.
comes up. And then
It
I've got to tell
does.
that doctor, we all know doctors know everything. And you have to tell
Yes.
that
Of
doctor, I'm
course.
sorry, the bank doesn't want to lend you money. And then they go off on a tangent. But it's just they didn't have the experience necessary.
Yep. Yeah. It does make a difference. Yeah. When stuff is going swimmingly, there's probably low risk. But when the you know the stuff starts to hit the fan, you need somebody who knows what to do in order to mitigate those losses and get back on the right track.
Absolutely, absolutely. And if you don't have the experience, then bring in a management firm that does. Bring in a strong
Yeah.
firm that knows what they're doing. And therefore you can lean on that firm as the source versus yourself. But
Yeah.
it's case by case.
Yeah. What's the difference between working with directly with banks versus working with a broker like yourself?
Well, there's the main thing is I'm not tied to anybody. I can go anywhere I want to. I'm not going to shove any product down your throat. I have the ability to sniff around, lift up rocks, and find the best deal. And so I go to the best deal. I don't go to. I'm not just stuck with our bank. Have to do what we say our three or four products that we have. I have the fluctuation to go anywhere I want to, wherever the best deal is for you. And usually that means I find money. I'm like, oh, this is the best money out there, and I spend it all. I'm like, yep, I gotta go out and find. It's like finding oil, Chase, and I gotta go out and find more money. But I'm not
Right.
tied to one bank. I'm not tied to one group. My goal is to find you the best deal, and so.
Yeah.
It gives me the flexibility for your group. It also gives you the ability to look at two different banks with maybe two different options, and then you get the term sheet and then you decide. So
Yeah.
it gives the sponsor the flexibility, and it gives me the flexibility to go to the best deal, not just to do the company product.
Yeah, and it makes sense. Every hotelier is different. Every hotel is different,
Yeah,
and you may not fit the box. And are you going to do the searching? I'm going to talk to 30 different banks, have the same conversation, the same information goes out, the same documentation, or you go to somebody that knows all of the options and knows how to navigate those.
And there's so many banks that are very just stuck on their couple franchises. I'm not going to name their names, but they only want this hotel and that hotel. But I know a couple
Sure.
banks that will do the other flags that most of them won't do. So
Okay.
instead of them going to door and getting turned down, look, I know who will do your flag. This hotel actually will do your flag. So it does save you a lot of time. And in many cases, we're borrowing from out of state, and so they wouldn't have been able to know that lender was available 4 states over that actually likes your flag.
Yes.
So it gives, for those that aren't doing the big 2 or 3 flags out there, it gives you tremendous advantage in knowing someone who knows that they actually like this flag, then they feel very comfortable, and this won't be an issue with the committee. Whereas some committees are just stuck on a couple flags, they won't stray away from those 2 or 3 big names.
Got it. Makes sense.
Yeah.
How can owners compare loan offers effectively, choosing the right one?
Well, but it must be in writing. So get everything. Don't consider an offer until it's in writing. Obviously, you want to look and see the strength of the bank. I'd rather borrow from a bank who's got $12 billion in assets than $1 billion. Also, I'd like to see. I would prefer a bank closer to me, to be quite frank. If I'm a up and coming
Hmm.
hotelier, I want to build that relationship with the bank. And if they're local or within an hour, I plan to be in this gig for 2 decades or so. I want to grow with that banker as he grows from a small little community bank to a regional bank. So the ability to work with maybe a closer bank, there's a certain advantage to that, especially for someone up and coming on the growth side of their career. Then on the I'm going to cash in a couple years and I'm out, so it's no big deal. So I always
Yeah.
try and
Yep.
it's always smarter to team up with a local bank and develop that relationship and then grow along with each other.
Right. Absolutely. Larry, I want to get you out your crystal ball.
Okay.
What do you see coming in the next 12 to 24 months for hotel debt and capital markets?
Okay, 20. I'm gonna go 12 first. 12 months, I
Yeah.
think rates are gonna drop 75 basis points. So I think that will
Okay.
be helpful. Gosh, we're gonna stop this tariff crap. We're gonna stop hearing all these excuses for tariffs causing all these international travelers to go away. Um, God, it'll be Trump's third year. I hate to bring politics up, but he's been doing a fantastic job, and I think we'll start to see more of the rewards of that as we stop talking about tariffs, stop talking about
Yes.
terrorists, talk about hostages, and see the economy flourish. You're going to see. I mean, if I was a stockbroker right now, I think I'd be very bullish right now on the markets because I think as our leader of our country has knocked off a few really negative things, and I think it's the floodgates are going to open up shortly. How much they'll open
Yeah.
up? Um, in 24 months, I could see rates being down at least a point and a quarter. So another, so to
Okay.
say, I mean, I'm trying to be conservative too. I think the floodgates will start to open. I think there'll have to be more lenders that will start to be more cognizant and more open to doing hospitality lending. I think in this market right now, so many lenders are just so afraid of any hotels, and we can't survive. I mean, banks have to lend to hotels, even if they're not home
Yes.
runs. You got to lend to doubles. If my debt service is only 1.24, but I have never missed a check or have paid my bills for 17 years in a row, we've got to lend that sponsor money. Otherwise, they're going to be forced to sell. And if everyone is forced to
Yes.
sell, it's going to bring valuations down. So I think
Absolutely.
we're going to need to be more. I think we're going to see I think we're going to see a good run here. I really feel good about it. And if in a worst case scenario, I think we lean towards uh, less, let say 0.75, three quarters to 1.25. We're not in a negative trend whatsoever. I would be utterly shocked if that was the case, but I
Right.
think we're in an optimistic trend and hopefully more optimistic than I'm even being. But I feel pretty good about our sector right now. I think there's a lot of good products in the market, a lot of good mergers. I feel the traveler people love to travel. Look, let's be honest. People love to travel.
Yeah.
Everyone is everyone has come back to travel again. The business traveler has been the slowest to get back, but even there, you're starting to see more companies mandating that companies bring their employees back to the office. And once you
Yep.
bring employees back to the office, they're going to start seeing each other more, and they're going to start going back to how it was pre-COVID. And I think you will see business travel in increase. Will it be the same levels we saw in 19 or 2015 or 16? I don't know, but I think they'll be better than they are today. And so I think I'm generally optimistic moving forward. How optimistic? I want to be tempered in how I say it, but I think a good run the next 3 years as our president's knocked off his biggest issues or some of his biggest issues, in my opinion. So
Yeah. Yeah, I agree. And I mean, debt maturities, right? That's
Yep,
been an issue that we talked about for at least a couple. I was just talking to somebody who's very big on the capital side of hotels,
yep,
and he was talking like they were predicting 2024. They're going to see a lot of debt maturities. It was going to start creating a lot of distressed opportunities.
yeah.
Didn't really happen too much. Same thing, saying 2025, that's the year. That's where everything's going to hit. We're going to see a lot of distressed opportunities. And they haven't seen that really hit. What's your opinion on what the next year looks like?
What kind of started happening, Chase, in 2022 when you kept seeing all these models that say CMBS do CMBS debts due. It's going to destroy the markets. And then we started to see some extensions. We started to see some banks work with some sponsors.
Yeah,
And that pushed it out another year and pushed it out another year. Because delinquencies have been flat in the hospitality side lately, I don't think there's going to be a disaster. I think there's always going to be a situation where a client is leaving cheap money and they're going to go to their when they're going to be going to more expensive money. Let's be honest. And you're not going to get the 4.5% debt you got 10 years ago.
yeah,
So, but if the rates go from 4.5% to say 7.5%, that shouldn't be a make or break on your hotel. Obviously, it does hurt your profitability, but it shouldn't turn you upside down. And
yeah,
so, um, it'll hurt profits, but I would say that we've also seen an increase in ADRs consistently the last 9, 10 years. And so when I'm doing pro
yeah,
formas, it's amazing how I'll look at these numbers and I'm like, guys, you're kind of light on this number. Why don't we call up the franchise guys that you're flagged to revisit these, because you got to start adding 8% a year on ADRs, because you're not. I think you're underpricing your numbers, and
right.
that's what been happening. As when we saw inflation, obviously no one likes to see inflation, but we're paying more for eggs, more for chicken, and more for meats. But clients are paying $15 a night more for rooms, and that was helping the bottom line too.
Yeah,
So I think there'll always be a fear of deflation or of default out there, but it seems to the worst is behind us in my opinion. And the only thing that caused more the only thing that could cause more problems or taking back loans would be if banks just stop lending money to hotels, and they're forced to. They're forced to either sell or give the hotel back to the bank, and I think we're past that stage.
yeah, yeah. I agree. On the broker side, I don't see nearly as much of those distressed sells as what I had anticipated a couple of years ago.
No, you still have a couple good flags out there that are giving some good rewards, some good key money to take over, turn it
Yes,
into this flag, which is nice. That's very helpful, believe me. But you're not seeing
yes,
a ton of just empty hotels that need a flag. So I agree with you.
right.
There's, but that's good, because I want those incentives to be higher to help out the sponsors to really improve. Give them 20 grand a key, whatever it takes to get that hotel flipped to their new flag, but also helps the sponsor out with some new injection of money at C of O or whenever the hotel is completed. So
Hmm.
uh,
Yeah,
it's a win-win for franchises that they make a bigger chunk of their market, but it helps out the sponsors in getting some nice key money to improve their property or just to improve the cash flow of the hotel for a short period of time.
yeah. That makes sense. You talked about the 75 basis point drop. I
Yep,
mean, even up to, one and a
quite a quarter.
quarter.
Yeah.
How do you think that affects how lenders behave in 2026?
Gosh, I don't know. I think I look at it selfishly from a sponsor perspective, and I'm saying it from simply a pro forma and punch the numbers and see how this hotel performs perspective.
Yeah,
I don't, from a macro perspective, I'm not smart enough, Chase, to know the examples. I just know that the lower the rates are, the deals pencil better, and if the deal pencils better and their debt coverage is better, that there's an easier chance for that deal to get approved. Especially
yeah,
if it's in a market that maybe it's just on the outskirts of Dallas, Texas, or on the outskirts of Nashville or Denver, where you're like, oh, we're kind of far away from the drivers. Those are the markets that are kind of challenging because they're not heart and center in the action, but they're close enough to the action that they should be looked at as a strong option. I'm more sponsor driven, and the lower the rates are, these hotels will pencil better. And again, doing a lot of SBA debt, which I've been doing lately, that number of 1.15 isn't that hard to get. And so if those
yeah,
little small fractures can get a hotel over the hump, then I'm going that route. Now
yeah.
again, if I'm looking at some of the more conventional side where I got to do 1.5, then then that's not probably the right option for them.
Yes, yep. Agree. Where do you see the best opportunities for hotel owners in the near future?
I'm gonna be careful how I say this. I still think the growth is in the South, to be honest. I feel the I've had more. I got a lot. I live in Southern California, Chase, and I have a lot of lenders that say, Larry, I don't want to see California hotels. There's just a tremendous boom, whether it's the rewards of the states. Texas was the first. Abbott was the first to throw out all these incentives to move to
Yeah.
Texas and work there, and then Tennessee jumped in. So you're seeing all these rewards, the momentum in the weather, and so I feel that still the South, and when I say the South, even the Carolinas, North Carolina, South Carolina, I got to go up that high as well because I'm seeing a lot of deals there. Columbia, South Carolina, the coast in North Carolina. So I think the action is still in the South, and that can change. And I'm
Mhm.
not saying the rest of the country just doesn't matter. It just feels like when I'm showing a loan to a loan committee, if it's in the South, I have their attention. If it's in Florida, I have their attention. If it doesn't appear in one of those southern states, I've got to really show what the driver is. Is there a new arena, a new building, a new company being built there, a new what's changed in Chicago, or what's changed outside of Seattle? So it just depends on the market, but I'm very momentum driven, Chase. A lot of my sponsors are momentum. That's because they can find flag opportunities in these areas. I mean, it's impossible to find a flag in Denver or a flag in Nashville. In some of these markets where all the flags are gone, you've got to go 60, 70 miles away from the driver to get the flag you might want. So in some of the southern markets, the flag isn't quite there yet. So there's again, that's why you're seeing such a boom to Tennessee. There's still a lot of land in Tennessee, still even in Nashville, that's
Yeah.
untapped, and it's
Yeah.
going to keep booming. It's going to
Yeah.
keep booming. So,
Yeah. Exactly.
and I'm a Southern California homer that used to be a big Pac-10 fan. All I'm talking about is SEC territory. So it does feel weird to say, but I'm just being honest with you, Chase. The South is still where all the action is at right now.
Yeah, and it is for a lot of reasons, not just hotels. And I think that they all kind of play together. That you have the population, that's where
Yeah.
people are going. You have the entertainment. You have so many things that are very strong in those areas. Naturally, the hotels are going to do better.
And don't forget the tax break, both personal and business. They're giving a lot
Yes.
of tax breaks in that in Tennessee, and it's helping.
Yep. Yeah. Yeah. Exactly. Larry, before you check out,
Yep.
you got to have your wake up call.
Yep.
A few rapid fire questions for you.
Sure.
What is one thing that you wish more hotel owners understood about approaching you?
That I'm not tied to any one bank. I don't. I'm on their when there's a table. I'm on their side of the table. I'm not the bad guy. I'm the good guy. So if there's some things that are a little bit of bad news, you're better off telling me now. It's going to come out later. So confide in me with everything that's truth, everything going on with this acquisition or refi, because I need to know. Because I'll need my lender to know. Because we're not the bad guy. We're all on the same side of the table. And so sometimes I think that they think
Yes.
I'm on the other side of the table, but I'm on their side. I work
Right.
for them. If we can't fund this, we don't make a nickel. So let me
Yep.
know the bad so I can help navigate it. And so oftentimes some of the bad isn't as bad as they think it is, but when you're in front of it and you put it out there first, it's easier to explain than when they find it out on the backside. So
Yes.
own it and stay in front of it is your best bet. And so often these sponsors they'll try and sneak it by. You're not going to sneak anything by an SBA background check. That's
No.
impossible. And then
Right.
when it comes up, it's always about the famous five C's. Character. Character is huge, and it destroys your character. And we could have, if we would have addressed that head on early on, it would be in a much different situation than we are right now. So,
Yep.
that's probably my biggest issue. Yeah, biggest thing.
Yeah. And I totally agree with you. On the brokerage side, it's very much the same. When I have a seller, we're getting everything packaged and taken, ready to take to market. I like to include everything, the good, the bad, and the ugly.
Yep.
Obviously, tell the best story. But if you don't say that the elevators weren't working, or you don't tell all this bad stuff, and then in the middle of due diligence, they start to find this stuff, then it's like, all right, what else are you trying to hide?
Yes.
Clearly, you're not, like you said, you don't have the character, you don't have the honesty and the transparency. Let's find where all the other issues are, and then you get retraded, you get canceled deals.
Well, that's how white deals blow up. That's because they've lost you've
Yeah.
lost your credibility and your character's
Yep.
been hurt, and so those blow
Yep.
up right away. Now, those are if I'm a loan committee, those are two red flags to me: character and credibility. And if I haven't funded that loan yet,
Yes.
that gives me reason to bolt. So,
Yep.
but you put it out there up front and discuss it up front, and we navigate up front, there's not a surprise at the end. So there's nothing to really
Yep.
complain at the end. So that comes up more often than I hate to, more often than I wish it did, but it does.
Yep. Yep. Absolutely. What's a deal breaker that you've seen that could have been avoided?
Again, it ties to some of the things like that, like just simple things like they missed a payment, or on an SBA loan they were a partner in a deal that didn't work properly, that they only had a 10% deal in it, but it still went bad. So it always comes down to just transparency. Tell me everything going on historically, both good and bad. I almost want to know the bad better than the good, because if you tell me all the bad, I know how if I can navigate this. If you just
Yes.
tell me the good and I find out the bad, then I'm in a different story. I hate to use the analogy, but it's like you're on a first date and you meet a girl. Tell me the worst things about you. If I can handle the worst things about you, maybe we can work. It's when I find those things out later. So just
Yes.
transparency and ownership up front. Because when you navigate up front, it's better than to having to explain it on the backside.
Right. Absolutely.
Yeah.
What's one rule of thumb that you live by when evaluating a deal?
Well, gosh, there's more than one, but again, like what do they always say in real estate? Location, location, location. It's really hard to screw up a property right on the coast in Florida, especially or in
Right.
Orlando. For
Yeah.
years, I used
Right.
to always make fun of Orlando. How could they get one more hotel there? And they build one more hotel here and it does 95%. And they build one more.
Yes.
It's kind of how Austin was. I equate Orlando to like how Austin was 8, 9 years ago when I thought it's going to hit a peak. And it still hasn't peaked. And Nashville today, it's not going to peak for probably 7 or 8 more years till they squeeze all that land.
Yeah.
But it's that's probably it. Just the location is so important. Performance is nice, drivers are nice, but where you're located, if you're right near a hospital, near a university, near Walt Disney World, near the beach, that's not going to go away.
Right.
They're not near an army base. They're not going to move a Fort. They're not going to move Fort Bragg away. It's going to be there forever. So it's
Yes.
location is important.
Yep. Yeah. Absolutely. All right. I want you to get out your rubber stamp.
Yep.
This is being recorded. What is one prediction that you'll stand by for the next 12 months?
One prediction I'll stand by. Well, there's still going to be some uncertainty in the market. I think there'll be. It just feels like I feel like we live in a world today where the media wants to find the negative going on. I feel like we'll still have a little bit of uncertainty. There'll be tempered optimism, but I don't think the floodgates are going to go wide open quite yet. I think we're heading in that direction, but I still think we're going to be kind of treading water for another. And when I say tread water, I mean, we're not going to drown and we're going to improve, but we're just not going to go, we're not going to sprint. It isn't going to be 2017 all over again. We're not going to be doing 9, 10% of hospitality up in one
Yeah.
year. I think that we'll be good. We'll be flat to good for the next 12 months. And then again, 12 to 24 months is where I see the real boom happening. But I think
Okay.
if you're a hotelier with experience, you'll get through whatever they're faced in the next 12 months. And I think everything that will come up will be positive. So keep your head up. I think rates are going to come down. I think you're going to see the international traveler return. I think some of these ICE things are going to be sort of put aside. I have sponsors that tell me that these ICE raids have actually hurt their business in California. There has been a lot of client travel, and they tell me that
Yeah.
they're hurt 8 to 10% because they don't want people who have of other they don't feel comfortable traveling. And so I think some of
Right.
those will be. I think it'll take less of a media. Those will start to be less and less prevalent. I think so.
Yeah.
Tepid optimism. Is that fair to say? Is that? Can I go with that?
Yeah. Yeah. I
Yeah.
like that.
All right.
I like that. All right. Good. And as long as it's improving, as long as we're moving in the right direction, I think everybody's happy.
Nothing to show me that we're not. You tell me one thing.
Yeah.
The if COVID comes back, maybe some attack of some foreign country, but everything seems peaceful right now. Whatever Trump's doing, everything, the world seems more peaceful today. So we can't be
Yeah.
blaming. I don't think that's going to happen. Obviously, China's scary. Well, maybe Russia a little bit. China's, China's got their markets getting clocked today as far as their stocks are down big time. But that's on
Yes.
China. That shouldn't affect us in the States right now as much.
Right.
But I feel that
Right.
all the core issues in our country are being addressed and moving in a positive direction.
Yeah.
That's all.
I like it.
Okay.
Last question, I promise.
Yeah.
What's one personal wake up call moment that you've had that has shaped how you look at financing today?
I want to be optimistic, and so I try and look at it from, like I said earlier, where we were 30 years ago buying a house in the Durrell Ford area when it was raised for 13% versus today where in the sixes or so. And so we're not that bad of shape. We're just not in the best shape we
Yeah.
were 6 7 years ago, but historically we're not. You can't blame. We're right in the middle. We're actually on the lower side than we were
Right.
historically. So
Yeah.
we're not in bad shape. It's just we were in the good times. Didn't realize we were in the best times ever, or one of the best times ever. So those probably aren't coming back. But realize that also the days of a mortgage double digits aren't probably coming back either. So I think we'll get through it, I guess.
Awesome. Awesome. All right, Larry, how can people get a hold of you if they're interested?
Well, uh, we have a website. Hotel Funding is on the web on my LinkedIn. LinkedIn's available. If you're in Beverly Hills, give us a call, or you can reach me on LinkedIn and get my phone number. In today's age, I do spend a lot of time in my home office because I don't need to travel as much
Yeah,
to LA, get stuck in traffic. So cell phone or email are perfectly good ways to reach us.
perfect. And we'll put all your contact information, your website,
Appreciate
your
that.
LinkedIn profile on the show notes as well.
Hey, I
Awesome,
appreciate the
Larry.
time, Chase. I love this. I really love the
Yeah,
hospitality sector. When people are out there talking about it, sharing information, that just benefits the whole sector. So thank you for doing this and being such a proponent to our sector. It's a really fun sector to be in.
absolutely. I agree. I agree. Awesome. Well, you have a good one, Larry. I will talk to you soon.
Appreciate it. Thanks, Chase.